Good afternoon. Good afternoon to everyone logging in. Welcome. Today's webinar is going to be a little bit different. We're going to more have a conversation style meeting as we're going to be discussing 1031 exchanges and their importance to the economy and what's going on within the economy. I have a guest speaker, Jason Matthews of Matthews Financial. He's going to come on and talk about a little bit about inflation and kind of where we are and his thoughts on what's going on right now with the inflation, with the economy, how that relates to, taxes. What are some of the tax implications for investors out there? And this is, all going to spill into 1031 exchanges and why that's critically important. And I think that we need to, and we're also going to talk, we're not going to have an in-depth 1031 exchange meeting. It's going to be more along the lines of the importance of it. What can we do to make sure that this, law stays intact, it doesn't get changed. And there are some action steps that we can all take. That's very important. And I think we need to be dialed into that as we get ready and prepare to kind of go into what we know is going to be I want to say more taxed, situation, but we know that there's going to be an increase in taxes somewhere in the economy, and where the taxes are going to come from, when they're going to come, how they're going to come, that's all up for debate right now. And I know within the context of what's going on in Washington and the different state legislatures, there's, this is going to be a battle. This is going to be a battle. Now, in real estate world, we've got a very strong lobby group that is, National Association of Realtors, and they do a lot of advocacy towards, anything having to do with real estate. Big part of what they do is fight for stuff like the 1031 exchange code, things of that nature that affect real estate. And so we're going to kind of get into that. When Jason logs on, we'll dial in. And here be the context or the format for today. When Jason gets in, we'll let him talk a little bit, give a little bit of an update where we are economics wise, talk a little bit about inflation, then we'll go into taxes, and then we'll transition into 1031. I'll kind of talk a little bit about that and what some of the important things are that we can do as citizens, as investors, as concerned parties, to help make sure that the government does not take that away. And then we'll leave the last 10 to 15 minutes for any of your questions, any of your thoughts, any of your comments in regards to that. And feel free, please chat your questions in. There's a Q&A area. I see a couple questions have come in. Oh, somebody says that the audio doesn't seem to be working. Let me know, guys. You can chat in now. If the audio, if you are not able to hear me, please let me know right now. You might not have heard that. I'm checking audio. It looks like on my end that we have audio. Okay, I hear audio is fine. I can hear you. So looks. Oh, Debasai, what's up, man? How you doing? Long time no see. Hope all is well. Sometimes when I log into a Zoom and I don't hear audio, what I do is log back out and log back in. That helps me out. But I just got off a Zoom graduation for my daughter, and audio was horrific. And as long as we've been on these Zooms, gotta love technology, right? Gotta love technology. But such is life. So while we're waiting on Brian, we're waiting on Jason Matthews. We'll just talk a little bit about 1031s and the importance of them in the economy. Look here, and there's a lot of things. We know the taxes are coming. We know this is going to, and probably the capital gains tax rate will probably go back to where it was pre-Trump administration. I'm not an expert. There's experts that are going to argue this back and forth, but we're pretty sure it's going to go back to where it was. It was dropped to 21% over the corporate capital gains tax rate. And that's what most people are paying. We think it's going to probably go back up to, I think it's 28 or 29%. Most likely that's going to happen. And what would be a double-edged sword is if they were to make that happen and then eliminate 1031 exchanges. That would not be a good look for anyone. And I really think, because what happens is you sell your investment property, now you're paying a higher, and that's all federal, right? We're not talking about the great golden state of California, where you at least are paying, I think it's 9.5% capital gains, if not 15% capital gains, depending on your bracket. So if they raise the capital gains tax rate and then take away the 1031 exchange exemption, the ability to defer, by the way, your capital gains taxes, I think that's going to have a really negative impact on the investment property market for sure. A market that has already been somewhat hampered. Now, remember, in real estate right now, the residential world, the residential market's on fire. You know, we hit the pandemic, there's a little snag, but then they lowered interest rates to 2-something%, and it's been rolling kind of ever since last summer, and it's continued to roll. And a big part of when people, you can get 2.5% money to buy a home, why not? So people are taking advantage of that. The commercial real estate industry, different story, right? People own apartment buildings, office buildings, retail buildings, hotels. Financing is not as easy to get as it is for a home. Now, the rates are extremely low, but the ability to get those loans are really, really just not, there. Well, I would say there. It's difficult. It is like pulling teeth. I've got a couple deals that we're working on closing, and it's been like 4-month closings. And we've had to change lenders mid-escrow, and that's happened to me 3 or 4 times during this, 4 times actually, during this pandemic, where we're working through a deal, 2-3 months in a deal, have to switch lenders. That's a gut wrencher. Totally different world from residential. So our world's already been affected pretty heavily by the pandemic, although we are now starting to see more investors back in the market, more lenders, more confident, particularly with the eviction moratorium, kind of winding down, or at least there seems to be a light at the end of the tunnel. Therefore, you're seeing more activity, but the market was seriously hampered. Now, particularly in the world of hospitality properties, retail properties, office properties. Those are the, apartments were affected, but not as heavily as those other food groups. So that's why I really think it's important for us as people who are involved in this business to be active. I'm not a political guy, at all. But one thing that we all have the ability to do is to have our voices heard. And in instances like this is a worthy cause to where you should be, emailing, mailing, reaching out to your representatives, your national, federal government representatives, your local assembly person, your local senator, your local congressperson. Reach out to your state people. Send them email. Even though state of California is a different thing, they all are in this world together. The way they make decisions is basically which way the voters are going to go. Politics in many ways is like a popularity contest. So these guys want to get re-elected. That's a big part of the business for them, because if you don't get re-elected, it doesn't matter what your plan was if you're not in there. So we have to let people know that this is important. We need this to continue. And the reason is that this economy, the investment property economy, is so vitally important to the overall economy. And that has to do when a property gets traded, when it trades hands. There's so many companies, people who benefit from that. There's not just the buyers, the sellers, the lenders, the title companies, the insurance company, all the different vendors that are involved in the closing, such as the inspectors, everybody that is involved when someone purchases a property. They're usually going to make upgrades to the property. They're going to have a property manager come manage the property. There's all these transactions that happen when one transaction happens. I read a stat a while ago when every one property that gets sold generates 2.5 jobs. I don't know what the half job is, but the bottom line is it's economic transactions that are going to circulate, reverberate beyond real estate. So that is critically important when we're talking about moving forward in this post-pandemic economy. I will say, however, we have there's going to be an increased tax base somewhere. We know this. They've put out trillions of dollars in stimulus money. The trillions of dollars of stimulus money, it's got to be paid back, y'all. It's got to be paid back. It's got to be paid back. So where and how it gets paid back is a totally interesting situation. And I see my boy Jason Matthews logging in right now. What's up, Jay? What's going on, man? How you doing?
Doing good, man. We also have one other person as well, with Thandiwe as well.
Okay, she's gonna join us on the panel?
Yes, sir.
Hold on one second. Let me make her a panelist. See her in there. What's up? How you doing, Thandiwe? How you doing?
Good. I think I'm trying to change my.
You are in there.
Yeah, it doesn't show my camera though. But
hold on, let me give it a shot. Let me. Maybe I'm not the. From my vantage point, you are made a co-host. You should be able to put your camera on. Again, the technical world. We've been rocking with the Zoom for a while, but y'all, you know.
Yeah, mastered it.
Brian Baldrez says hit Alt V, and maybe that might help.
okay, do you see me now?
Still not now. Hold on one second.
There's a picture.
It's okay. I might have to be a picture, but we could go ahead and continue.
That's cool. Well, let's dive into it, guys. Oh, I done took my picture away. All right. So what we're talking about, and I just was kind of laying down the importance of keeping the 1031 exchange within the tax code and how that relates to the economies. But I want to hear you guys talk a little bit about the economy within and then talk a little bit about, you know, inflation and then taxes in general. And I'll kind of wrap with 1031. This stuff is all, you know, it's all connected. And that's the thing I think as real estate people, we need to understand. It goes beyond real estate. And sometimes we get in our own box. Got to see the bigger picture and what's really going on. So Jay, Thandiwe, let's talk a little bit, hear from you guys in regards to what's really going on out there in the economic streets in May 2021.
You want to go ahead and lead, T?
Sure. I mean, and I was kind of listening to what you're saying and how it connects to the real estate market as well. As you know, things have been pretty heated up, but I think it's not going to go as down as quickly as people thought it would, especially this time last year when a lot of people thought, oh, you know, it's not a good time to buy, but here we are a year later and the real estate market is still doing well. So I think when it comes to inflation, we kind of have to take a step back because all these different items that especially relate to real estate like lumber, steel, are now being more pricey. You see more people getting renovation. The costs have gone up dramatically. And so we really have to start taking that into consideration as far as how much value our dollar has in the, not only now, but in the future as well.
Right. And definitely add towards that is right now what we see is over the last, since COVID, we had a huge stimulus packages, bigger than we ever seen in our lives. With the two with the Trump stimulus package, also the third one with Joe Biden. And now we're talking about another one with this new infrastructure plan that just came out a couple weeks ago. Yesterday, the Republicans came out with a counter of $1 trillion. And which is crazy because remember in 2008 financial crisis, Obama did 760 billion. We thought that was a big deal. And now we got the T's like it's nothing. $1 trillion here, 2 trillion here, 3 trillion. And because of that, I think like Thandiwe said, we see it for the cost of housing with inflation, but I think everybody sees it in its traditional ways. You know, my wife does grocery shopping and she goes to the grocery store. I'm like, what do you spend all the money on? We got nothing to show for it. And so we see with the food, we see with gas and other things. But due with all this money printing, you're going to have to pay for it in some type of way. And either that is through traditional tax increases or through a stealth tax, which is usually through inflation. And you keep hearing the numbers on inflationary issues, and we're seeing that drastically right now. And today, the new inflation numbers did come out, and they're showing we're really high, like we're back in the 1970s almost with inflation, which is a crazy number. And due to this money printing, the money has to go somewhere. But if you look at the bond market right now, it is showing, it doesn't think that there's inflation, as the 30-year yields and 10-year treasury yields have actually got stagnant and flattened out recently. So we're just in this interesting time that nobody knows what's going to happen during this period of time. But we do know that the cost of goods and services are going to go up. We also do know that last year we was worried about how all these people going to get foreclosed on, and it seemed like that slowed down, or we've been kicking the can. And Steve, you see it in commercial real estate as well. So we don't know. What are you seeing right now in the commercial real estate space right now, Steve?
Well, I mean, like, okay, so you guys talked about like materials, and material costs have gone up outrageously, particularly lumber and also steel, right? And so people, at the same time, there's several development projects still mid-development. Like if you go downtown Oakland, there's still a bunch of cranes in the middle of a project. And so that, as I've talked to a couple of developers, a couple of lenders, is a concern, because obviously when they got their loan in the past, probably before the pandemic, it was based on a cost structure that was at that time. And obviously that's a big difference right now. And so also home builders are experiencing that. One of our clients made an offer on a new build home, and part of what the negotiation of back and forth, and they ended up backing out of it, was, hey, the costs for this construction might go up in escrow. And how you deal with that, I'm sure there's an efficient way to deal with that. At the end of the day, somebody's taking a loss somewhere, or paying more than they wanted to pay. And it's gonna have an effect. And so essentially that means profit margins are gonna be a lot skinnier for a lot of these developers. And as I was talking right before you came on, the importance of each property transacting, putting money into the economy is critical. It's a big part of why they kept the interest rates low, so that homes could continue to trade, because when people buy a home, they're gonna go down to Home Depot, they're gonna buy a bunch of stuff, they're gonna do stuff, they're gonna hire people to do stuff, they're gonna have friends over, they're gonna go to the grocery store and buy stuff. It's a huge part of the economy. You talk about commercial real estate. We've been seeing this boom before this time hit. And what that boom related to was a lot of new development. And so a lot of those developments were caught in the middle of this pandemic, where you had to shut down construction for a while. Timelines were all pushed out, and now you're dealing with an increase in cost. What we haven't seen in a major way yet is a serious increase in defaults. Lenders are working with, for the most part, are working with borrowers now. But how long that's going to last, we don't know. I mean, it's a new frontier. We're going to find out though here soon. So I think the impact of the cost of material will affect commercial real estate in one way or another, also in a leasing standpoint, because a lot of times a tenant comes and leases up a space. They're negotiating for the landlord to pay for the tenant improvements, or they're going to pay for the tenant improvements. Lumber and steel, and that's all up. And leasing market in Oakland and San Francisco, for instance, is really, commercial leasing market really slowed down from where it was again. And in many ways, that's not a bad thing, because it was outrageous. I mean, there needs to be a balance. But again, if you were doing any kind of renovation on a project, new construction, or you just bought a property prior to the pandemic, you were counting on rents based on that time frame. And in many cases, those rents are down. And let's say you're struggling to get a tenant. If you get a tenant, you may have to finance or put up the money for the tenant improvements, and that can be that. So we'll really see how that plays out, but there's a lot of concerns in those space. At the same time, and I'm always keeping it positive for y'all, it should mean that there's going to be some deals out there, and that you can negotiate, and that you don't have to, wrestle against Alibaba and the 40 Thieves to get a property in commercial investment real estate. Although there's not a lot of inventory, hopefully we'll work through this market with solution oriented brokers, investors, and developers cutting deals that make sense. That's what I'm hoping to see. Not a lot of people losing, but cutting deals that make sense. Maybe we can get back to that.
Hey, Steve, on the home flipping side, I know a lot of times when people doing home flips, they get a lot of hard money lending.
Yeah.
And they have very tight with their numbers. With the cost of lumber and the cost of labor and other things going to a home flip, do you think we're going to see those home flippers giving great deals? Do you think they're going to lose that property because of they can't, those numbers, or even just getting the lumber and everything is hard to get at this time on that time, on the time margins they have for themselves? What do you see with that part?
Well, I think it all goes back to who's doing it. So if somebody's got they've been doing this, they got the crews, they have the expertise and the wherewithal, and therefore that probably means they were buying right. I think they can weather the storm because they're probably going to have connections that somebody's just getting going don't have, and they know how to work the deal. And because the housing market, single family home, is so hot, they're gonna, for now, right? You can kind of, when things are really hot like this, you make a mistake, you go over budget, whatever, you can kind of hide that because you probably get multiple offers on a well-priced home. However, everybody ain't rolling like that. So a lot of people doing home flips are novices. A lot of people doing home flips are just getting going and not having the wherewithal to maybe float the payments or stretch things out, find the connect. Because again, a lot of this stuff has to go to connection. You got to make the right call to get this lumber in some cases. And if you're just getting in the game, you may not have those connects. And so that's who I worry about. And so, by the way, the foreclosures that we are seeing, because we track this stuff on a weekly basis, are pretty much all hard money loans, residential and commercial. Now, with residential, the foreclosures that we're seeing on, and I say residential, home owner occupied residential, is the foreclosures that were on before COVID. Because we were tracking this. I know we talked about this a couple of times. In Oakland, before COVID hit, there was 166 residential foreclosures. And that had almost tripled since the summer of 2019. Because we've been tracking it. So that was beginning to be a concern. A lot of people actually got bailed out by the COVID. But now that the banks can foreclose again, there's a lot of people looking at foreclosures that were already in foreclosure pre-COVID. If you went in COVID and made, you got a lot of love in terms of when you stop making your payment. But if you were in default before that, it's back in action. So the lenders who don't have no mercy, the lenders who are not really flexible, the lender who is not really, so concerned about your situation, is the hard money lenders of the world. They are the ones who are foreclosing right now. They're the ones who are difficult. But again, it is a relationship business. And I go back to that because if you got a crew and you're doing, 3 to 4 houses at a time, and you're closing 3 to 4 loans at a time, that lender is more likely to work with you than if this is just your first 1 or 2 deals. And they're like, hey, you know what? If I take this property, we're in at a good, we can quickly sell it and get this done. A lot of them think like that. So that is what you're saying is a concern for the newer investors, the people who are not as adept to, navigating through, really timelines and costs of the materials. People who have been there for a while should be able to navigate through it. Now, I would just tell you though, I think it's a concern for all of us going down the line because you can't put out trillions of dollars like they put out and it not have some kind of effect. The effect's going to be inflation. When, where, how much is all going to be interesting to see.
Right, definitely. Speaking of inflation and everything, when we talk about that, you're going to have to pay for inflation. We're starting to see with this, with the President Joe Biden administration, and you're hearing about more and more of his potential tax plan, and it seems like they're throwing everything on the wall. And so one of the things that are on the wall, there's 2 things I think are going to affect real estate. One is 3 things really, I think. One is estate taxes. The second is step up in basis, and the third is 1031 exchange. What's your thoughts on how it's going to affect 1031 exchange? And then second, how you think it's going to affect step up in basis, Steve? For your
Well, yeah, I mean, the step up in basis, man. And for you guys, let's break that term down for a minute. And I'm just going to give you an example of a deal I'm working on. The family, it's a trust. So the family inherits a property, commercial property, from the son. It's the grandmother, the mom is the trustee. She's the one handling everything for the trust. Her son passed away. When he passed away, the property, the trust, the heirs, they got a step up in basis equal to the value of the property at the time when he passed. What that means is this: what the basis is, in layman's term, from a basic way of explaining basis is the cost of the property when the buyer acquires the property. Now, that minus any depreciation write-offs that, as investors, we enjoy the depreciation write-off. It's a 27.5-year schedule for multifamily and residential housing, 39.5-year schedule for commercial properties, where you get a write-off. So that write-off amount, however much you've written off your property, that gets taken away, that minuses from the basis, but you can add to your basis any capital improvements, any major, not regular maintenance, but any major capital improvements to the property. You put a new roof on it, you replace all the windows, you buy new heating and air conditioning, that gets added. So that formula, what you pay for it minus your depreciation plus any capital improvements, is a layman's way of understanding what your basis is. My client, when he purchased, the trust, when their son who passed away, he purchased a property, I want to say about 500-something thousand. When he passed away, they had it appraised at 1.25 million. And so their step up in basis, their basis went up to that 1.25 million because that's what the property was worth when he passed away. So when the trust received the property, they didn't receive the property for 500,000. They received a $1.25 million property. Now we go sell the property. Pandemic hits. It's a retail property. It's a vacant unit. Property didn't sell for the appraised value, significantly under that. The good thing for the family is that there's not a gain. They are not realizing a capital gain on that property because of the step up in basis, right? And this is all basic. Maybe I'm not an accountant, but they had the basis remained at 500,000 when they inherited it. When they sold it now, we're selling it for 850, then they'd have to pay a pretty hefty capital gain on the 350 or so of gain, of which, at the end of the day, they didn't buy the property. They didn't get the property at 500,000. Their son who passed away did. They got the property at the $1.25 million value. So the step up in basis, and there's other examples of step up in basis. That's the one I mainly deal with in real estate. My practice is when people pass on, they give it to their heirs. If things are done properly, like in a trust, it's a lot smoother, right, than probate or something like that. But when that is done and done right, you get that step up. If you were to sell a property, you're not hit with some major capital gains tax. So if they take that away, essentially, I think that is also a major hit to the investment real estate world, particularly because so much of things are driven based on taxes in this space. Now you talk about 1031 exchanges. We need that. We need that as a marketplace. We need that as an economy. It's so vital. And I think the reason that 1031s, every time there's tax reform, this ain't the first time, y'all. It gets talked about being eliminated all the time. I think the perception is that this is something that the big corporations always take advantage of and use to not pay taxes and get wealthier. But the reality is, this is a way a lot of the small property owners, small business owners who own their business property, how they build their wealth portfolio. And it's a great way for someone who's looking to move up in the world to do so. And you don't have to come from great wealth. I mean, you could buy a house, sit on that house, sell it, take the proceeds, buy an apartment building. I know so many people who've done that, not having PhDs or MBAs or things of that nature. And I think, in my experience, this 1031 tax deferral part of the tax code really, 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 really benefits the small entrepreneur, and which, by the way, is the backbone of the American economy. The big corporations make a lot of money, they employ a lot of people, but without small business, we would not be the economy that we have been and that we are, period. And so that is something that we need to keep in place, just from a business real estate market perspective. On the greater scheme of things, when you look at the economy, without the 1031 exchange, code being in there, a lot of deals are not going to happen. They're just, people are not going to sell their properties because does not make sense to pay. And you're in California, you'll be paying anywhere from 28 to 35 to 40 something percent in capital gains tax. So if you make $1 million and you have to pay 400 to 450, you're probably better off just keeping that property, especially if it's profitable for you, right? And even now, where you have the ability to 1031, so many sellers are hesitant to sell because if I sell, I got to pay taxes, and the only way to not pay those taxes, which is defer those taxes, is to conduct a 1031. And there's other ways, such as opportunities, qualified opportunity zone funds, and some other things. But most people want other properties, so they know if they don't want to pay or they want to defer those capital gains taxes, they've got to do another 1031, and which is not an easy process. That's why a lot of my videos and I'm doing a whole 1031 exchange series right now, because it's not easy doing a 1031 exchange. It is a difficult process, but one, if and when done properly with the right team, can really accelerate one's wealth, and in a way where you're not having to reinvent the wheel or do something outside the context of what you're already doing. It's the concept, if anybody ever played Monopoly, it's the concept of trading your 4 green houses in for 1 red hotel. And that's like the key to success in Monopoly world, right?
Yep, get that one hotel on Park or Broadway, and then you're waiting if they live.
Now you're good. Everybody got to pay you,
waiting.
Right? So but okay, that's what, and I'm in my experience, hey, it's the small investors that benefit from it the most. The big corporations, they always figure out how to minimize taxes, man. So if this goes away, they're gonna figure things out. It's the small mom and pops that I'm most concerned about. And when I think about the real estate market, it's so many of those transactions that are so critical to a community that if this gets taken away, I think it's going to do more harm than it will do good in terms of the tax revenue. And I just think they're going to lose tax revenue, and anything that they gain in the removal of 1031 is going to be taken away by all of the missed tax revenue that they're going to get in other sources. And I just think you're going to have a significant drop. Doesn't mean that necessarily property values are going to drop, but I mean the transactions are going to drop. And that's it's not a great thing. You need transactions like we said at the beginning of this conversation, every real estate transaction, creates 2.5 jobs. So what we're really talking about here is stagnating the economy if we take this away, because we're going to really hamper transactions. That's critical. And as you guys, and I'll turn it back over to you guys talking about the economy, we like what you said, look, we got to pay for this one way. You can't put those trillions out there and let's not pay for them, right? We at some level need to be able to be prepared to pay for them. It's a matter of what's the most efficient. So I just think when you take away real estate transactions, you minimize job growth, and you're not getting that much more money, I don't think it's that effective. And that's why I think we need to advocate. But for you guys, looking at, as financial advisors, in the economy, talk a little bit about your, thoughts on 1031 and steps up in basis and how that relates to kind of the financial market in the financial world, and does that, if at all, change how you advise people as you're setting up their plans?
I think taxes in general are something that definitely have to be taken into consideration when you're putting together a financial plan. Obviously, that's one of the biggest thing is, okay, I don't want to use the word avoid, but how do I defer paying taxes? And so when it comes to real estate being a really great place to do that, I think when you're talking about the 1031 exchange, I know you said this, being a very complex process, but also being very very beneficial for the small mom and pop shops versus some of the big corporations. And I think hopefully, I mean, I'll just say, my opinion is that we need to continue to have these transactions, because I see more people definitely getting involved in real estate this year. And if you don't have those different ways that you can actually take advantage of that, I think, a lot of things could definitely change in the next couple of months or in the next year. So yeah, I think that's definitely a huge part in making sure that we're not just talking about, whether it's a 401k, Roth, other investment vehicles, but like making sure real estate is also part of that conversation when we put together people's financial plan.
Yeah, absolutely. Absolutely, because it's the whole wealth portfolio, right? It's everything.
Yeah, exactly.
And man, taxes is a big impact, and
Huge impact, especially here in California.
Yeah, especially in California.
And what you don't want to happen is you don't want to lose the volatility of money. Where you want money to get spent and the volatility of money. The issue comes when money just stays put and real estate stays put. And now it just becomes a bank and there's no flow of money. And I think the problem we're going to have with that, what we have to be conscious of in America is people are having a hard time moving up the ladder in America. And with the 1034-5 in the step up in basis, both of those are strategies that people can do to move up the economic ladder of America that America dream has. And as it has been getting more challenging for the average American to do that, and you get rid of this, the question is going to be, are we going to have more of the haves and the haves not? Will the wealth gap continue to separate because of this? Or with the 1031 exchange and the step up in basis removal will allow newcomers to get in the game as the price value drops. But that home price does not drop, then we're going to be in another world of trouble if it does not at
right,
that point.
right. And here's what, and that's so to speak to that point. When, especially investment property owners, when they're looking at, hey, I'm not going to sell my property because if I sell my property, I'm going to pay taxes and I can't exchange. That's probably going to mean less inventory. And that, less inventory is usually not, it's hard for the prices to drop if there's no inventory. There's demand and and we're in a low interest rate environment and people have capital, people want to invest. But if there's not a lot of inventory, then what people start doing is fighting over what is available. And then when that happens, prices usually, at least out here, they go up. And so or at least stay where they are. So, that's why I said, if they take that away, I don't see the prices dropping, but I see the transactions dropping. And that just, now everything's a fight, everything's a battle. And you know how, look, man, when it's like that, you talk about the haves and haves nots, the haves is going to be eating and the nots is going to be struggling more. That's why, and then like what we talk about, it's about moving up, stepping up, moving up the ladder, moving on up like Jefferson's. That's what an exchange allows you to do. And that's why I'm spending so much time on this, teaching people, because a lot of people over the last few years have been able to get their first investment property. Through our company, we've had a myriad of people do that. We're helping a lot of people do that right now. And we say, hey, look, you get this investment property, and then let's talk a few years, because now you take that little fourplex you got, exchange that up, and get you 16 units. And what happens when it's said exchange is gone, they're just gonna hold on that fourplex. Why would we sell it? Because then if you got to give 30 to 40% away, you have less to play with to go into a market that's probably going to be competitive. So, and you got, you probably were, if you were making money on that property, why would you go ahead and sell it at that point? So you're going to have more people wanting to buy properties, less people, less properties available on the market, less dollars circulating around, and I think that helps the gap expand, man. You know what I mean? And that's why I don't think it's good for anybody. And outside of Republican, Democrat, Independents, outside of all of that, I think this is one that it doesn't really work for any group. And that's why I just think, like what you said, man, they are throwing everything up against the wall, which is what they typically do, right? When they're trying to figure this thing out. And this ain't no easy thing. I don't want to like point the finger at the government saying, hey, y'all raise taxes. We know, look, Democrat style, they probably gonna raise some taxes. We know that's coming in. The thing I hope that they would do is to really truly evaluate that whatever they're gonna raise taxes at, where they're gonna raise, when they're gonna raise, that the impacts of them, and figure out, all right, well, we got to raise it somewhere. Maybe over here is going to have less of an impact. Don't tax the highest impact place that's going to have a significant, fallout to the economy. You know what I mean? And hopefully they do this incrementally, not all at one time. So, you know what I mean? As we're going through recovery, as we're getting out of the pandemic, as we can go back outside and play, let's just not slap everybody in the head with some major taxes on all different fronts, right? I mean, what do you guys think in terms of like just the flow of the when and the where of these taxes that we know are coming?
Well, I guess one thing, especially with this new administration, is that it really was targeted at increasing the taxes for high income earners and big corporations. But one thing I also wanted to get your opinion on is on the other side of that was having more tax credits available. And I'm sure you've heard of for the, it wasn't passed, but through the first time home buyer grant credit. And just the view that we're going to increase taxes on one side, but on the other side, we're going to have more tax credits available so that this new market could get into real estate. And it's kind of twofold, because it's like, does that really help the other side? Like, is it necessarily equal in that realm? And so, just getting your opinion on what you kind of thought about that and how it affected the real estate market and what the potential could be, for newcomers coming in.
Yeah, and I think what I do see the new administration doing is trying to make every effort for new homeowners. And I think that's a great thing. That's home ownership in so many ways. Now I know there's different argument in the real estate investment world. A lot of people who argue against owning a home, but at the end of the day, look, home ownership is a staple, I think, to wealth, because it provides stability for your home. If you can imagine renting a house and then get a knock on the door, hey, we're selling a house, you got to go, but your kids are in that school district, maybe your job's down the street, and trying to get into that same neighborhood where you've been renting for years is going to be an extensive cost increase, right? That can be devastating to a family. So owning your real estate, controlling your address, has an intrinsic value to it, obviously an economic value to it, and that rise in, there's a rise and fall of values, the paying off your mortgage. So tax credits are critical to getting people in the homes. I think we need to see that, and I hope they continue to see that. Where tax credits dipped off a little bit, and when in the old administrations, where for affordable housing, low income housing developments are all fueled by tax credits. And so with when dropping the taxes, that actually kind of cooled that market off a little bit, although deals has always been getting done in that space, as they should. And so that's the one thing, that if there is an increase in taxes, I do think it only makes sense that there's an increase in tax credits and availability of that. I think more and more investors will run to tax credit type deals in order to get that help and that relief. Because we know it's coming from somewhere. We just don't know where it's coming. And I think that as we're getting closer to wrapping up, the thing that sticks out to me is that, look, we do have some power as citizens here, and we got to start, using that to our benefit. And we've seen that in this pandemic. You've seen the power of the people. When George Floyd went down, and it was an uproar, man, and it wasn't just Black folks this time, upset. It was everybody, and that had a significant impact. And I think that when you look at it as, hey, look, we do have a voice. Let's exercise our voice. Times like these, require that. So I think that, like, for instance, we talk about 1031. I think everyone should write their, federal people, whether that's your, local senator, congressperson, write somebody. Now the 1031 exchange companies are going to be coming out with, like they did, I want to say in 2018, possibly, when there was talk of the 1031. They sent out emails to where you simply open the email, you click, show your support, and they're sending that out. They have big lobbyists that they're working for, CAR, NAR, National Association of Realtors. They're going to be lobbying for this. NARAB, I hope is going to be lobbying for this. NAREP, ARIA, all the different associations in real estate, CCIM. Everyone is going to be advocating for this. So if you are interested in keeping this alive, now is not the time to sit back on that. You don't have to be in the streets protesting with it, but let your voice be heard. You can write a letter to somebody. You can sign a petition. You can be active, and this is that time, because they're gonna tax it from somewhere. And I think the way it probably works is the squeakiest wheel gonna get heard. So whoever making the loud enough noise is who the politicians are gonna listen to, because they want to get reelected, man. So if this is important to you, let your voice be heard. Next month, I'm going to do a webinar. I'll bring in one of the 1031 exchange QIs, qualified intermediaries, and we'll go more into depth about what you guys can do to, make sure that 1031 stays around. I think this is critical, man. I mean, especially as we talk about, and you guys know, you guys are part of, Urban Financial Services Coalition. I'm part of NARAB, the Black Brokers Association. We are fighting for the building of Black wealth, and the this wealth gap that exists. We are trying to squeeze that thing down. We're not trying to see it expand. And I just think that the 1031 is a way that someone just coming up can really move up and move up without having to, reinvent the wheel, so to speak, not having to invent the app, if you will. They can, get them their 4 greenhouses, roll it up to a Run Red hotel, and build some wealth for their family. So let your voices be heard. Reach out. Next month we'll have one of the QIs in the building talking about what we can do as a community of people who are concerned about this. Let our voices be heard and make sure that this stays in. And as we got about 12 more minutes, you guys have any final closing remarks before we kind of open it up for questions and talk to folks?
I guess one thing I'd like to add is really, as we talk about all these different things from, 1031 exchange, and also the proposal to eliminate the step-in basis, it's just like this really has a lot to do with equity in building and creating your legacy. So I think it's important, like you said, for people's voice to be heard, to make sure that we're able to actually pass this on. Because it's important, especially when people are just getting started with real estate and they want to have somewhat more of a long-term plan. So I think you did a great job today just explaining everything and really highlighting the importance of why we should care about this issue, especially if for those folks who are interested or already in real estate.
Absolutely. Thank you.
Yeah, definitely. Yeah, I think Thandiwe and Steve, you guys did it great. A couple of things we hearing this is, one, be proactive, right? Be proactive for as talking to your legislators about how you feel about taxes, where you see tax increases are going to come. Like Steve said, squeaky wheel gets the most attention, right? Gets the oil. And so I think it's important that we are proactive, talking to our Congress people, so we're not the ones getting the taxes, but it goes somewhere else, hopefully to major corporations, so on and so forth. The second thing is not just be proactive as far as legislation, but be proactive in your own planning for stuff. Know the situation and start making adjustments now. We can be proactive or we can be reactive. Reactive is saying, oh man, they raised taxes, I don't know what to do. Proactive is knowing where the situation is going, seeing where the field is headed in the next 5, 10, 15 years, and even closer up, and start planning now accordingly towards it. Not just in your real estate, but in your whole portfolio. So I just want to leave that point for all you guys as well.
Well, I mean, I thank you for mentioning that, because a lot of our people who log on to these webinars, people who, because this guys will be on YouTube probably by 5 o'clock today, people who watch our YouTube station are all mainly real estate folk. And the thing I see the most consistent upon, whether it's somebody who has one single family house or 1,000 apartment buildings, is that we're all just dialed into real estate. The folks that I see who have kind of really set themselves up properly, I got a couple clients that come to mind right off the bat, is they've taken the time to set up the total financial picture. You know, they're looking at retirement plan, their estate plan, you know, just where they have a lot of cash, where their liquid cash needs to go. And because they take a lot of risk in it, when I see a lot of people who take risks in real estate with their cash, they like to be conservative. So they might throw it in insurance or annuities. You know, it seems like real estate and stocks are, those investors have different philosophy, but there's even some real estate investors I know who invest in stocks and do well. But it's just not being so tunnel vision to real estate. It's about seeing, I can't tell you how many times I see people own investment properties in their personal name or own their home. They don't have a trust, they don't have an LLC, they don't have any sort of estate plan, and they don't have any sort of insurances beyond just the regular property insurance, right? So these are things that we need to be aware of when you're out there investing. And if you're a professional in the business, you need to be advising people of these things. It's not, you know, and I think we have a fiduciary responsibility like you guys do to your clients, to give them sound advice on how they can move their investment portfolios or investment lives forward, man. And that's talking to somebody like Jason and Thandiwe. That's important. You know, that's why we've been doing this for what, 10 years on these webinars, seminars. Hey, and by the way, y'all, we looking forward to getting back into doing a physical seminar in person with people sometime soon. I'd stay tuned to that. I don't know what that's going to be, but it's opening back up out here. We in California, in the Bay Area. It's the most shut down of the shutdown, but it is opening up. The mask mandate, I think, gets lifted next month. And we will be doing a physical seminar sometime this year. So stay tuned to that. Now I'm going to open it up for anyone who has any questions, thoughts, comments, or anything that we can address before we break. I want to get us out at 2 o'clock so you guys can get back into your day and you can be productive, go out there and make some money, go out there and do some good. So let me, I see we got a couple. All right. Okay, Debasai puts in, what about the rent control laws passing in Oakland? You think it will go back to the old rules, or will the same or worse? All right, so this is a doozy. And when you talk about rent control laws, okay, first of all, Oakland, San Francisco, Berkeley probably has some of the toughest stringent rent control laws, period. When COVID hit, everything just got exacerbated, right? So the eviction moratorium, which federally is lifted, state of California still in place, Oakland, San Francisco, it's still in action. Here's what I think. I think the pendulum swung seriously during the pandemic to the tenant side. The tenants and the rents have gone outrageously high here in Oakland. So the legislators, again, and mostly the voters are mostly tenants. So they're going to go with the tenants, man. They're going to go with what the tenants want. Now, at some point, they're going to have to open up this eviction moratorium in the city of Oakland. I don't think the rent control laws, though, are going to lighten up at all. I don't see that. I hope that they don't get more stringent, but I don't think they're going to lighten up, not in the near future. I think what will probably happen at some point, they'll open up the eviction moratorium, but them rent control laws, I don't see them going anywhere anytime soon. And it is going to be a bit of a mess operating and navigating through when we're able to open up and start back doing evictions again. It's going to be a little bit of a mess because you got some legitimate situations, and then you got town tenants bobbing and weaving through through, you know what I mean? And look, man, it's always going to be somebody like that. You got some legitimate people though that were in a legitimate situation, couldn't pay rent, and landlords are not going to be able to collect on 100% of their back rent for sure. I think maybe 25% of what they could get, but it's going to be interesting, and I don't see it lightening up, man. Just because, again, majority of tenant town, and the government's going to go the way of whatever the voters are saying. And the good thing, here's the one thing, I think the rental market cooled off a little bit, and I know a lot of landlords and investors don't necessarily like that or want to hear that, but I think that we're going to kind of get back to a point of normalcy within the market. We have a bunch of new buildings coming online, and that should balance some things out. And I just think the natural course of business will start prevailing after we come out, after they remove the eviction moratorium. But it's tough doing business here, man. It just is. It's my favorite city in the whole wide world. I love this place to death. This is my home. No matter how crazy the people are sometimes, how we got some violence issues we dealing with again this year. But it is a tough place to do business. It's why the A's are looking at other places now for their stadium. And I hope that they don't move. But the way the city of Oakland government is operating, I couldn't even blame them if they do, because they're not working with them. So that's the challenge for us entrepreneurs doing business in Oakland. There's a lot of benefits of doing business here, but I just don't think the real laws are going to open up at all. I do think at some point this year, hopefully, we'll be able to get back to that. And when they do open up the evictions, it ain't gonna be just everybody out on the streets. It's gonna be really on a case-by-case basis. Landlords, they want to evict. You got to have your paperwork right. And again, if you've heard me talk about this, have an attorney do it. Not try to do your own self-eviction. That's the worst thing you could possibly do, because it's tough, man. You make one mistake, then your case gets thrown out, and the tenant gets to not pay you no rent and live up in there. So make sure that you deal with that. Next question. Thanks for that question, man. Next question. Okay. Deborah asks, can people look at REOs if you're not a real estate agent? You guys post them anywhere? Where's a good place to look? Okay, great question on that. So I'm gonna give y'all a resource called Foreclosure Radar. Actually, it's called PropertyRadar.com. It used to be Foreclosure Radar, but if you type Foreclosure Radar in, it'll go to Property Radar. Property Radar is a valuable resource. You have to pay for it. And that shows you what properties are in default, what properties are going to trustee sale, what properties go REO. And you can reach out and go directly. Not a huge uptick yet in that. However, most of the major mortgage companies, the forbearance plans end in June. So the majority of banks, Wells, US Bank, B of A, Chase, and they're doing the servicing. Even if it's not their loan, they're doing the servicing on most of these loans. They're going back to, you got to make your mortgage payment in June. So I think come, 60 to 90 days beyond June, we will see an uptick in, because somebody ain't gonna be able to make that payment. Somebody ain't been paying the mortgage for a year. They got used to not making a mortgage payment. They got that EDD money, and they on Instagram balling out. The mortgage is coming back, and so I think that's when we'll start seeing that. But go to foreclosureradar.com, propertyradar.com. I think it's like 50 something bucks a month that you pay. So if you're serious about the business and doing deals, I say get on it and track it. I mean, we've been tracking this stuff since 2011 when I started a company in 2009 and really start, with foreclosures, and that's what we were doing. And so now we've been really monitoring and tracking it There's not a big uptick in foreclosures yet. The only ones I really see are hard money lenders, and then loans that were in default pre-COVID. But stay tuned to that, because, man, I think we're going to see a lot more. A lot more. So great questions, man. Great questions. I don't see any more that are in the chat, and it's 2:00 right now. I'm going to get you guys out of here. Thanks a lot. I hope this has been helpful, because we are really trying to get quality information out to the marketplace. And I think in this world of content, that there's a lot of content out there, but there's not a lot of value. And so what we're trying to do at our YouTube station, on our webinars, on our videos, and I know you're doing the same thing, Jason, is to give value in our content that you guys, you investors out there, you entrepreneurs, can take, go do some deals, go do some business, network with people, interact, and go make some things happen. So you guys have a great rest of your week. Go out there, be productive, see how you can bless someone else, and let's do some business, y'all.
Everybody have a good afternoon.
Hi, everyone. Thank you.